All right, thanks for joining. Let's talk about delta. So we got in a little bit to option Greeks, just very basic introduction. And so now we're going to just peel a couple layers on the old onion and talk about what delta is. And at a high level, it measures price risk. It measures the risk that you have, risk or reward that you have when price moves, when the underlying price moves. Now, we talked about the main three Greeks that we're going to look at, delta, theta, and vega, and why they're so important. And this is the one I would say, we probably will pay the most attention to because price movement can happen fast. You have probably seen situations where prices moved 5%, 10% in a single day, especially with a stock, not so much with indexes. But big moves can happen around earnings especially, or certain events. And so I need to know, what is that going to mean to my P&L? What is that going to mean to my position if price moves a lot? And that's what delta helps us figure out. So there's three ways that delta is commonly used. The first one is the one I've been talking about, and I think one of the most important, or the most important. It measures the risk of underlying price movement. So if I have Apple and I bought an option at, when Apple was at 150 and Apple goes to 160, what does that mean to my position? What does that mean in terms of my profit and loss? There's a couple other ways though that delta is used. So one of the ways is to quickly determine, and it's just a rough kind of quick and dirty way to know the probability of expiring in the money. I'll show you an example of that. And the third thing is that it can be used to create an option position that's the equivalent of owning the actual stock. So instead of buying Apple stock, maybe I want to create an equivalent position, but I want to do it with options. So delta will help me do that. And I'm going to give you examples of all three of these. Okay, so first one is delta measures the risk of underlying price movement. So if I look at this example, now this is the same example I used in the intro to Greeks, where I've got this larger position of 10 contracts on. I put it on for a $5 credit, or near a $5 credit. And the important thing I want to call your attention to, though, is this delta of 237. What does that mean? Well, quite simply, it means if the underlying price moves $1, this is how much my P&L will move. So if price goes up by $1 from 150 to this is at 156 on this day. So let's say it went to 157.35. My profit would increase by $237. The opposite's true. If it dropped by $1, I would lose $237. So delta helps me know, what if price does go? I mean, if Apple has an average true range, let's say Apple on average moves $5 a day. I don't know. I don't think it moves quite that much, but let's say it moves $2 a day. Well, I know that on an average day, I'm going to be plus or minus $500, which is probably fine for a position this size. This is a really big position. I'm looking to make 5,000 and risking 5,000. So, plus or minus a few $100s is probably normal. But regardless, this is what it is. Now, delta can also be negative. This is a bearish position, but you'll notice the delta on it, and I'm looking at this center. This was one where Apple's at 150, and so this is the current price, and it tells me that if Apple goes up $1, I lose $31. It's quite a bit smaller position. You can see this one is one contract instead of 10, but on this particular spread, I have $31 at risk. If Apple goes up $1, if it goes up $2, I'm gonna be down $60, and so on. Now, one of the nice things about this analytical software is that I also can put price slices in at different places. So you'll notice I have one way down here. This dotted line is a price slice. That's the minus 10% line. So if Apple were to lose 10%, or if Apple were to gain 10%, I have a price slice there, it tells me what the delta is. And you'll notice that, and this is important, as price changes, delta changes. That actually is what gamma is. We're not going to talk about gamma, but basically, as price changes, the delta will change. Well, how much does it change? That's what gamma can tell you. So you don't need to know that right now, but just know the simple idea that as price changes, that delta can change. Your T+0 line, which is this purple line, is what this is based on. It's not based on the expiration line. It's not based on the blue line. It's based on the current T+0 or time +0, meaning today. So you can sort of tell when the line is more slopey. Up here, way over here, you can see the line gets a lot flatter. Well, when the line's flatter, you've got a much lower delta, much less risk, right? In other words, when the line is flat, price can sort of go either way, and it's not going to make a big deal. As the line gets more slopey, then you have more risk. Okay, so just know that take away from this, delta can be positive or negative, and that delta changes as price changes. All right, now delta can also be used as a probability of expiring in the money. So if we take a look at let's just look at an example of maybe this one here. This is a 90 or a 92 delta in the money, right? Very deep in the money. 92 delta is very high. And the probability of expiring out of the money is about 8%. That means the probability of expiring in the money is, guess what? 92%. So roughly, your delta will always be, and again, it's just a quick and dirty estimate, but it's usually close. Here's one out of the money. So this is an 11 delta. So we would say it has an 11% chance of expiring in the money. Well, it's close. This one says probability of expiring out of the money is 90%, which would be 10%. So you can see that it's not exact, but very close. And if you go up and down, and puts are the same thing. Here's a put at a delta of roughly 12, and you can see that it's about 85%. So they're not exact, but they get pretty close, right? This one here is real close. So generally speaking, if I want a very rough estimate of what are the chances of getting to that point at expiration, delta will tell me that. Okay, now the third common use for using delta is to create a position that's equivalent to owning stock. So in this example, well, let's look first at what owning stock looks like. Okay. If I wanted to own some Apple stock, actually I'm looking at Lockheed Martin here. If I wanted to own some Lockheed Martin stock, what you would find out is if you owned 100 shares, you'd have 100 deltas. That will always be the case with any stock. 100 shares will be 100 deltas. Why is that? Because delta is always the value. How much will your position change if the stock moves $1? So if the stock moved $1 and you had 100 shares, you'd make $100. Therefore, your delta is 100. So if you owned 50 shares of Lockheed Martin or any stock, your delta would always be 50. It's always a 1-to-1 ratio because that's how much it's always a measure of $1 movement in the underlying. All right, now let's say I wanted to create the equivalent position with options. Well, what I did was I found a delta of about 50. It was slightly less than 50, as you can see here, and I bought 2 of them, and that gets me close to that 100 deltas. So what's going to happen here is if the price goes up $1, I'm going to make $100. only I'm just doing it with options instead of stock. So I've created a position where my P&L will be close to mirroring the stock ownership. The question though is, why would you do this? Well, if you remember back from one of the first videos we did, which is what is an option and why would I use it, it's going to look very similar. So one of the reasons people do this is the risk reward. If I were to buy 100 shares of Lockheed Martin at $360, it's going to cost me $36,000. That's how much I would have at risk. And if, let's say, the stock goes to $365, I'm going to have a $500 profit, right? $5 times 100 shares, easy math. Now, what if I were to do that with options and I were to buy 2 of the options I just showed you in the previous slide? They were about 20 bucks a piece, so I have to have 2 of them, right? And remember that 2, which is $40, times 100, because I need to control 100 shares of stock, we would be at $4,000, right? So $4,000 instead of $36,000 at risk, and yet I'm still profiting at the same level, $500. Hopefully that makes sense. And if you remember back from, again, that first video when we were talking about why people use options and what an option is, this is the same kind of example I gave against Apple. But that's the idea. It's one of the key reasons that people will do it is they can control the risk. In this case, almost an order of magnitude better in terms of risk, and have a chance for the same kind of profit. So that's one of the main reasons. But the main thing to show you here is that there is a way to construct a position with options using delta that shows us how I can profit or loss the same way. All right, so this is how we do it. How we use delta: measure risk of the underlying price movement. This is one of the key things, and we talked about it a fair amount, but you're going to see a lot more examples of it. We need to look at delta so I know if price moves, what am I facing? What is the probability of expiring in the money, and how can I construct a position that's similar to owning the stock or the underlying security? A couple other characteristics of delta. One of the things is, and we showed this in that one example, delta will change as the underlying price changes. So if you remember the one picture we had with the plus 10% and minus 10%, we had completely different deltas than the current at the money. So delta will change. It will also change as time passes, and it will also change if implied volatility changes. So there are different things that cause delta to change. Not something you need to worry too much about right now. Just be aware. Don't be shocked if you were to look at a position and the delta was this, and then the next day it was something that you weren't expecting. It could be one of these other factors. It will change. I think that's a key thing. Okay, so that's delta, and we will leave it here and move on in the next module to theta.